Why do the boring strategies win? In investing, excitement often feels productive. Fast trades, bold predictions, and constant adjustments create the illusion of control. Yet history repeatedly shows that the most boring strategies, simple, rules-based, long-term approaches, tend to outperform. Here's why. 1. They minimize human error. Much of underperformance comes not from bad assets, but from bad behavior. Research by Daniel Kahneman and Amos Tversky demonstrated that humans are systematically irrational under uncertainty. We overreact to recent news, recency bias. Sell winners too early, disposition effect. Hold losers too long, loss aversion. Overestimate our skill, overconfidence bias. Boring strategies, like index investing, systematic rebalancing, and buy and hold, reduce decision points. Fewer decisions equals fewer behavioral mistakes. 2. They reduce costs, which compound against you. Frequent trading increases. Transaction fees. Bid-ask spreads. Taxes. Slippage. Even small frictions compound over time. As John C. Bogle, founder of the Vanguard Group, emphasized, in investing, you get what you don't pay for. Low-cost index funds outperform most actively managed funds largely because they avoid excessive fees and turnover. Boring equals low turnover equals higher net returns. 3. They exploit the power of compounding. Compounding rewards time in the market, consistency, patience. It punishes interruptions, emotional exits, strategy switching. A steady strategy allows returns to stack on top of returns. As Warren Buffett famously noted, wealth often comes from sitting on your hands. Exciting strategies reset compounding. Boring ones protect it. 4. They avoid timing errors. Market timing feels intelligent, but research consistently shows that missing just a handful of the market's best days drastically reduces long-term returns. Those best days often occur near the worst days, when fear is highest. Boring strategies stay invested. Exciting strategies jump in and out. Staying invested usually wins. 5. They scale emotionally. Exciting strategies demand constant monitoring, rapid decisions, and high emotional tolerance. This leads to stress, burnout, decision fatigue. Boring strategies are psychologically sustainable. They are easier to follow during crashes, bubbles, and sideways markets. Sustainability matters more than brilliance. 6. They embrace statistical reality. Markets are competitive. Outperformance requires someone else to underperform. Active trading is often a zero-sum or negative-sum after costs game. Passive, diversified strategies quietly capture market growth, economic expansion, corporate earnings growth. They don't try to beat the system. They become the system. 7. They remove ego from the process. Exciting strategies feed the ego. I predicted that. I caught the top. I sold before the crash. Boring strategies remove identity from performance. They rely on rules instead of brilliance. Ego is expensive. Rules are cheap. The paradox. Boring strategies feel slow. They feel passive. They feel unimpressive. But they reduce mistakes, reduce costs, preserve compounding, eliminate timing errors, scale emotionally, align with market structure, and over decades, those small advantages accumulate into large outcomes. Final insight. The market does not reward excitement. It rewards discipline. In the long run, the most powerful edge is not intelligence. It is consistency. And consistency is usually boring.